Rob's Child here with another edition of Security Analysis. Today we're doing Chapter 33. Nothing I say is investment advice, and I have no intention to replace any contents of this book, but to discuss it and open it up for comments, open it up for discussion. I'm hoping this can be a place to discuss this wonderful book on the internet, sort of functioning like a forum. So chapter 33 is probably, in my opinion, the most irrelevant chapter that we've had so far in this book, and I'm only saying that because I think regulations since this was written have changed a lot where this isn't as much of an issue, but I don't know that for sure. So the title of it, Misleading Artifices in the Income Account, Earnings of Subsidiaries. And the title pretty much says the entire chapter. To be honest, I did not get a whole lot out of reading this chapter because it's kind of just the same point over and over and over and over again. But we will go through it anyway. So let's start with the summary of the chapter in case you just want to watch the very first part of this video to kind of get the gist of it. In a nutshell, the idea here is that parent companies can and often abuse their subsidiaries by either counting their profits as part of their own earnings in ways that are a little unscrupulous, or holding on to those earnings so that the company looks better in future years, or making the losses of its subsidiary not count against its earnings or count it against its earnings, depending on what the company is trying to do. There's just all these examples of parent companies pretty much hiding what's going on with their subsidiary companies. And the main points at the end are that he basically says that companies should count subsidiary losses against total earnings with no tricks, even if it's non-recurring. Let the investors decide what's going on. So the chapter begins to go through point by point. He discusses it in this first section as a padded income account. So like I just mentioned, using the subsidiary in a way to pad the earnings. He says one of the worst examples of this is the company Park and Tilford. They transferred a huge net asset loss to their goodwill and trademarks, trying to hide their loss. The money went to advertise their subsidiary. Essentially, they hid this from investors, and he attributes it to bad accounting. They didn't share the balance sheet accountant. I think this was the part where he said there was no accountant name on it, so they couldn't track who done it. But yeah, so they didn't have a balance sheet. It's easier, I think, today to get company balance sheets. They're online. You can. I don't think we have a lot of these problems still today, like I mentioned at the beginning of this video. One thing interesting, he says, if there is a case of trying to determine if the company is trying to obscure their earnings, he says to check the taxable profit, the federal taxable profit, to see if earnings are either way off or at least close enough. Because if they're way off, then that might be a sign of manipulated earnings. And then he suggests that company prospectuses get rid of minor matters. He says that like so many times companies will put out in their prospectuses things that really don't matter to investors, and too much stuff that doesn't matter, and that a detailed reconcilement of net earnings reported with the net income that is taxed should be in place of all of the nonsense that they usually put out there. So he's basically complaining about how companies put out a bunch of information that's irrelevant and try to purposefully hide the most relevant, most important information, which is, where's the money? What's going on with the money of this company? What are they doing with the money? How much money is coming in? How much money is going out, etc., etc. I mean, in essence, and this is, a specific part of it, but we'll move on. There's a famous example. I know it's famous because I looked it up online afterwards about this cigar company he discusses here. I believe that this is completely antiquated, this complaint here, because I believe we have more standard GAAP accounting methods that make it so this isn't as much of a problem anymore. But this company, he talks about, counted the value of the store's real estate that they are leasing going up, the value of that land that I believe they don't even own. They're just leasing it, but the value of it going up, they counted that value increase as profit for their income account. So you can imagine, at least that's how I understood reading it. And that's very manipulative. That's very tricky. And he suggests after that point that if someone were to check the federal income tax, it could have helped investors see the real truth as to what's going on in that specific situation. Then he makes a point here that suggests that you should shun all securities. He uses the word shun. Shun all securities of companies that are doing these kind of tricks in their accounting just to make their books look better. He says it's a bad practice, and as an investor, you should just try to avoid them altogether. He sounds a little angry in his tone, even through the words of this book. So then we repeat again. Companies can use subsidiaries to manipulate earnings, basically, and this also includes even having a minority stake. So say a company, we'll use one of his examples, but in like a imaginary sense. If you have a railroad company that owns a third of a coal company, and the coal provides fuel for the trains, that controlling stake doesn't completely control it, but anything over 10% or 5%, I believe, is considered a controlling stake. That controlling stake has an effect on how they do business with each other, and it can give the railroad an advantage. And this is a good thing, but if it's losing money, that portion that they own needs to be, those losses need to be counted against the earnings of the whole the company as a whole. That's kind of what I get out of this. If I misunderstand anything, please, again, comment in the section below. And again, I think a lot of these points are probably antiquated, but in essence, in the 1930s and prior, companies often hid their earnings and liabilities of their subsidiaries, and it sounds like it was a pretty big problem. And again, I don't think it's as relevant as a point today, but it's important to definitely take a look at earnings with a magnifying glass. I think as I talked about in the previous chapter as well, if you don't get anything else out of this, realize the impact of non-recurring costs against the company, non-recurring things that happen, and deferred payments, and anything that affects the earnings. Like to understand what are the earnings, why are they what they are, what's the trend look like, why is it in that trend. But let's get back to this chapter. So he goes through more examples of bad accounting, and he basically says, companies will do this in some cases to keep their credit worthiness acceptable enough. Specifically, he says for trust fund investments to hold their debt. So that's the thing. Their earnings go down too much one year. Let's say it's going to give them, even within the bylaws of the company, it's considered to be a default because it's not earning enough earnings, even if it can cover its debt. And then all of a sudden it can't have its bonds held by this investment trust, so they have to go out into the market outside of that, and all of a sudden the market outside of that sees, oh well, they're not legal for the trust fund investment anymore, so we're going to need a little higher yield. And then it puts even more pressure on the company. So there's the reasoning behind trying to keep the earnings steady of a company makes sense, that the company wants to give the investing public confidence in their company. You get it, but at the same time, it's really up to the investor to understand what's going on, and it shouldn't be in the hands of the company to manipulate earnings to just make it look good year after year. Put bandages on it when it's bleeding. No, we got to see what's going on. And so that's pretty much what I got out of this whole chapter. Another point here is that if a subsidiary is losing money and it's one of these companies that gives the parent company an advantage, like in that railroad coal relationship, for example, or like a cheap service, having losses of the subsidiary can be worth it, for the company to continue holding the subsidiary instead of trying to liquidate it or get rid of it, because it's giving it that sometimes the parent company is depending on the subsidiary so much that it can't afford to let it go. And so there are complexities involved with companies and their subsidiaries. Just because a subsidiary is not doing well, it's not good enough of a reason for the company to get rid of that subsidiary, for example. So I think that was a really important point and has some deeper implications to think about when you're dealing with companies that have subsidiaries. So again, like I said at the beginning of this video, in a nutshell, the way I see it, the parent companies abuse their subsidiaries sometimes for various reasonings, usually to make earnings look more steady, or just have an effect on what it looks like on paper as far as their earnings go. Again, I don't know how relevant this is to today. And then he makes these last points at the end of the chapter that basically boil down to that companies should count subsidiary losses against their total earnings, even if it's non-recurring, and it should be clear in their documents to investors what exactly is going on. And I think no tricky business. Don't put the money here and then there and then there and then there and then be like, oh, and that's earnings now. That's in a nutshell what this is all about. I hope you enjoyed reading this chapter. Please discuss in the comments below, and I'll see you next time. Rob's Child.